Welcome to Building Success Series with Nick Ainis, author of Building Success, The Art of Real Estate Investing, and Building Success, Start a Business, Grow a Business. We're here to break down real estate investing, business growth, and making money. No fluff, no gimmicks, just real strategies from experts and insiders who have built success. If you're ready to level up and create wealth, you're in the right place. Let's go.
Yeah. Wasn't that better?
Hey, I took your advice. I sped up my intro, and if you say it's better, I feel it's mission accomplished.
It's way better. You can get better, though. Even better.
I feel like finally I'm off the hot seat here, because the most recent episode of the Building Success series was you coaching me. The spotlight was on me, but now somebody else gets to have the spotlight on them.
All right. Hi, Jimmy.
Hi, Nick. Thanks for having me.
Yeah, my pleasure. Well, you know what? The reason I have you on my show is because I listened to you. We had a online virtual meeting. It was with a couple of friends of ours, Eric Rodriguez, and it was pretty amazing. Your wealth of knowledge was incredible on the financing aspect, and you're probably I'm gonna suck that knowledge out of you today, because you were like very smart. Clearly I could see you knew what you were doing and knew what you were talking about, and I want to talk more about it and hear what you have to say. And today's focus is going to be on how the missing middle housing. So just a little bit about the show here. So Building Success series, I wrote a couple of books, The Art of Real Estate Investing and Start a Business, Grow a Business. And so we're taking it to a podcast level and trying to get people to talk about, making money, investing, and particularly a focus on real estate because that's the industry that I'm in. And so I thought it would be a cool idea, and I have lots of fun doing it. That's why I'm doing it. I'm passionate about this kind of stuff. But I want to see if more people can participate in this missing middle housing, because I think there's a broader appeal to a lot of smaller investors that might be able to get in on this. And I think if you look at the overall real estate investment market, it's really tough to become a developer. Like if you're doing some big projects, they're very tough. They're very sophisticated, and it's tough for the average person to get in on that unless they invest through another company or REIT or something like that along those lines. And there's obviously some benefit if they can participate in the real estate market in a different way. Maybe they're smaller projects. And,
I totally agree. I think obviously we have a housing crisis in Canada and require a whole bunch of supply. But I think we also need a diversified lens on that supply. People keep talking about low density single family homes as well as larger condo or apartment buildings, but we also need everything in between, which I think is something that's lacking in the market right now. Yeah,
because let's face it, like I have, I build condos, so I should be promoting the condo. But if you actually, you basically have two options: a condo or a house.
Exactly.
Getting housing today is difficult. Buying a house today is difficult. You need a lot of income, and you got to have impeccable credit rating and everything like that. And you need a big down payment these days. So it's difficult to get into that market. But there's no other options. And I think that's what this missing middle is pretty cool, because, there's an option for people if they want to live somewhere else and they don't want to, be in that big condo or, that very, where there's a big community. And I've lived in a condo and I've lived in housing, obviously, and it's a different lifestyle. Maybe not everybody loves that. There's an appeal for having that privacy, so to speak, and living in a house is kind of like that. So if you can't afford a house, maybe it's a duplex, maybe it's a triplex, maybe it's a quadplex or fourplex, and we have to have options for people. But before we get into all this, I want to talk a little bit about who you are, your background, and your role at GreenBirch Capital. Let's start with that. So tell us your life story. We want to hear from the beginning.
Yeah. So my life story, I've been in the industry now for almost 14 years. I've been at GreenBirch Capital, who's a commercial mortgage broker, for just over a year. We cover all markets across Canada for the exception of Quebec. My job at GreenBirch is Vice President of Origination, primarily covering the Ontario market. Prior to joining GreenBirch, I was at First National Financial in their commercial department for 10 years. And then before that at Laurentian Bank, also in their commercial real estate department for nearly 2 years, covering Southern Ontario. So,
okay, so like hang on, before you go, so you didn't go way back. So where are you from? Are you born and raised in Toronto? Where's your...
Yeah, so I was actually born in Montreal. And then moved to Toronto when I was about 2.5 years old. So, really grew up in Toronto, specifically in Mississauga. So that's where, I was really raised and spent most of my life. I went to university at Wilfrid Laurier in Waterloo.
Okay, nice.
And then I also spent 4 years in Vancouver while I was working with First National. So I've covered, many markets across the country. So I'm well diversified with commercial real estate right across the nation.
And what's your nationality? What's your background? Like Castong? How do you pronounce your last name there? I want
Castonguay. So that's French.
French. Bonjour, comment ça va? Ça va bien?
Ouais, ça va très bien, et vous?
Comme ci, comme ça. But that's all you're going to get out of me, unless it's Tabernacle.
That's okay. That's good enough. Yeah.
Okay. Well, I do I pronounce it pretty good, I guess. My French accent is not so bad.
You did, yeah. I mean, just a quick side story. So my brothers and I played hockey when we were younger, and anytime somebody had to announce her last name on the PA,
it was awful.
Was just
was it laugh?
Yes, it was. It was brutal. I mean, I've heard 100 different variations, all of them incorrect. So,
well, my last name is Ainis, but everybody used to call me Ainis.
Okay, yeah.
And everybody's saying,
so
Nick
we both
Ainis.
struggled over the years, yeah.
But then it just became a joke. So, after a while, I used to get pretty embarrassed when the teacher would say, "Nick Ainis."
If your teacher is spelling it or saying it incorrectly, I mean, that's definitely a big problem.
It's Ainis. I had to correct everybody. Ainis.
Yeah.
But anyways, so that's great. Great to hear. So you're right now with, how long you been with GreenBirch?
Just over a year. So I joined them in February 2024.
So your role is actually, what is it? Getting new business? Is that your primary role there?
Yeah, so I mean, I guess it's twofold. It's obviously trying to find new clients and build those relationships, but it's also helping existing clients build their portfolios.
Oh, that sounds good. So really exciting, I'm sure, for you right now. And how old are you?
I'm 36.
36. Wow, you're doing good for 36. That's good.
Yeah, I mean, I joined the industry at a younger age, right? 22, I believe. So it's.
You got your license and everything like that?
Yep.
Yeah. I almost tried to get my license too. I'm crazy about these things. I want to be everywhere at once, but I just focus. Now I'm kind of just focusing on what I can do.
No, exactly. I found that, it's better to just be an expert
on one thing.
Yeah, exactly. On one thing in one niche, and really just try to be the best that you can.
Yeah, good advice. Good advice. So, what's GreenBirch's experience with residential and infill housing and the missing middle financing? So, is this a normal finance for you guys for that type of housing, or are you guys involved in a variety of different financial mortgaging and financing?
Yeah, I mean, as a company, we do cover a broad spectrum of financings. I would say that multifamily, and specifically, CMHC multifamily, makes up about 75% of the volumes that we did last year. That remaining 25% would be a variety of commercial financing, so retail, industrial, land, that kind of transaction.
Yeah.
On the CMHC side, or really the multifamily side, we of course cover both term and construction. And in terms of I guess deal type, again, we do cover anything from small to big, but me personally, I do focus on what I would call the smaller and mid-market product. So
That's cool.
that
So
would
I'm talking
be
to the right person then, right?
yeah, exactly.
Nice. So what is your typical deal size? Give me an example.
I mean, a lot of the deal sizes that we're looking at these days, I would say would be in the, call it $3 to $10 million range.
3 to 10 million.
And that would be, and again, depending on market, that's what I would consider, the smaller end of the spectrum.
So it could be
especially
like
in a market.
Go ahead.
Yeah.
Go ahead.
No, I was just going to say, especially in a market like Toronto or really, Ontario in general, where, a $5 million loan could be, 10 units essentially, right?
Yeah, that's a good level of what we want to talk about today. That's great. Yeah. So awesome. So definitely talking to the right person. And so what do you see? So define missing middle in your eyes. What do you typically see for missing middle multifamily? What are you seeing these
missing
days?
middle in my opinion is anything that is has obviously a smaller number of units, but also what I would call like lighter density. So in the city of Toronto, something that's popular, or at least has been popular over the last 12 months or so, is the 4+1 developments. So that would be like a fourplex with a garage or a laneway suite. Now, a lot of people focus on that when they talk about missing middle, but in my opinion, I think it can be a slightly larger form of development as well. Toronto last year came out with the major roads initiative, which would allow minimum of 10 units on certain sites on major roads across the city. So I would also classify that as.
Is that official now, or?
I think so, yeah. Or I mean, who knows with the city, but
sure.
But really for that definition, I would still consider call it those 10 units, and even slightly larger to form the missing middle. So call it lower rise or mid rise developments in the city. So maybe even 10 to 20 units. In my opinion, that's still considered missing middle. So if we're looking at the full spectrum, maybe 5 to 20 units would be that missing middle.
Great. That sounds pretty cool. And you know what? There's something about living in, let's call it more boutique style, smaller developments for people who really don't want that huge condo high-rise experience, right?
Exactly. And you see a lot of those types of developments in other major cities, right? You go to New York, or especially the European cities, where you have these 6 or 7 story walk-up buildings with about 20 units, right? I mean, it doesn't have to be the 45-story apartment building.
Yeah.
I think that you could gentrify a neighborhood with this missing middle to create more of a community feel without obviously having these massive towers taking over an entire city block.
And the question is whether you can make money on it. That's what it's all about.
Yes.
And that's the challenge. That's one of the challenges, and that's probably what we're going to talk a little bit more about today. So I think, so when you, in your experience, when, like, this is kind of like a new thing that we're talking about, but it's been around for a while. We're no stranger to smaller projects, but in terms of the condo industry, smaller projects typically didn't work too well. And that's kind of like, and it's easy to get a group of people to do a project together. Someone who's willing to invest, wants to invest into rental housing. They want to make money for themselves. They want to, I don't know how much they want to put into a deal, but it's certainly an opportunity for people to sort of participate in the real estate industry as a group and get into this multifamily structure. And there's lots of ways of doing it, and I think that's a cool thing that you're focusing on that deal side. So, but I'm going to ask Toronto Mike, you engaged here, or what's happening?
Yeah, the missing middle
Checking
is
your emails.
You know, I have conversations with people like Sean McAuliffe, for example, from Spacing, for example, or Ed Keenan from the Toronto Star. The missing middle is seems like a quick fix for some housing issues we have in this populace.
Yeah, you talk to councillors too as well in the city of Toronto, don't you? Have Brad
Bradford, Amber Morley, Diane Sachs. These are all people I consider friends. Yeah.
Yeah. And do they talk about housing a lot on your show?
Well, Brad Bradford is huge on that. Of course.
Yeah.
Of course. We got to get Brad Bradford on building Toronto skyline.
I'm game. Making my next guess.
I'll text it right after this.
Yeah. I'll put him on. Maybe he's a good guy. I got to be nice to him though. But
He's a great guy.
So Jimmy, I just wanted to get Mike he was looking at his emails, so I had to just
Re-engage him.
Yeah.
I was sending promotional messages on social media telling people about the great Nick Ainis.
Oh, that's good. So you're allowed. Okay, so Jimmy, let's get back to business here. So in terms of the barriers to financing for missing middle projects, what are you seeing? What are you struggling with the most? Is it the cost of the land? Is it, or whatever, infill housing, or is it cost of construction? Are people getting a break on development charges? What do you see common financing challenges for this type of housing?
Yeah, I mean, there's a few challenges. One of the most common challenges that's at least discussed in the media is development charges and how expensive it's gotten from a tax and municipal standpoint. So I think that especially if you're building a multifamily rental product, there should be concessions, or at least reductions in development charges when it comes to that type of product.
Are there right now? Are there right now or no?
And that's actually, I was going to get to that. But in the city of Toronto, for example, you could get development waivers if you build a fourplex. And then if you close out that building permit and then apply for your garden suite or garage suite, then you could also get development charge waivers on that 50 unit. Now, the biggest challenge is folding it into the financing side, because the most popular program, at least in multifamily development or investing in Canada, is CMHC multifamily.
Yeah.
And CMHC defines a commercial multifamily building as 5 or more units. So when you look at these 4+1 developments in Toronto, because the entire site is made up of 5 units, that would qualify for CMHC financing.
Right.
The issue, at least from the development side, is that you would need to, if you're applying to CMHC for construction financing, you would need all 5 units to be approved by the municipality, prior to getting that approval from CMHC. In which case, you would need to, get your building permit for 5 units, which would now disqualify you from your development charge waivers, because the only way to get it done is if you, like I mentioned, apply for 4 units, build those out, close that permit out, and then apply for the 5th unit.
Well, that's ridiculous.
So now there's a disconnect between what the financing side is requiring versus what the city is demanding.
So why does the city should wake up to that issue and change it?
For sure. I mean, and I think that's where one of the greatest problem lies, right? Is the mismatch of communication between different levels of government and their agencies. So for example, the city of Toronto not aligning with, the federal agency being CMHC on, what's transpiring in the market and what's possible from a financing standpoint. But it's also, at the federal level where, you have the federal government, of course, saying that they want to bring more supply of housing to the market. But then CMHC, at least as of late, curtailing their risk appetite on the financing side. So you have, the same level of government and one arm of the government essentially, doing something different than what, at least publicly, the federal government is saying and doing.
Yeah, it's unbelievable, and that should be easy to fix.
Exactly. So, I mean, if you had full alignment, I think right across the board, it would make, of course, development easier and financing easier.
Right.
So I think, one thing that obviously should be looked at is cutting red tape and, just making that process more efficient and easier for developers.
Okay. So then I'm going to ask you another question. So if I'm a real estate, I'm listening to the show right now. I want to invest in real estate. I want to do multifamily. 5. I should be thinking 5.
Yes, you should be thinking 5. Yeah, because
okay.
Now it doesn't work for every project because there are debt service limitations. So being the NOI against the annual mortgage payments for your property, but in theory,
don't try to use abbreviations. Don't use abbreviations. So let's go. Try that again.
Sorry,
because you know what? A lot of people out there, they're new to this, and they may not understand. So start again, please.
Yeah. So the debt service coverage ratio is your NOI divided by your annual mortgage payment. So that would be your principal and interest payment. Through CMHC, there are 2 primary programs that you could apply for. The standard market program, which has been around for a number of years and is CMHC's legacy multifamily program. That program has no social criterias, so you could apply based on the debt service ratio as well as the loan to value or loan to cost of the property. CMHC also has a second program called the MLI Select program. This program launched in March 2022 and it does have social criterias, meaning that you need to apply and get approved based on 3 social criterias: energy efficiency, affordability, and accessibility. You can mix and match the various criterias, meaning that you could apply for one criteria or a number or up to 3 different criterias, and it is a point-based program, meaning that the more points you get, the more benefits you get out of the program. Now, I mentioned all of that just to come back to the 5 units, because through CMHC's programs, like I had mentioned, you do need a minimum of 5 units. But CMHC's financing programs do offer the most benefits compared to any other financing available in the market.
Right.
And on the MLI Select side, so long as you meet, the minimum debt service coverage ratios and achieve the maximum number of points through the program, you could, in theory, go up to 95% of cost for new developments. So whether that's construction or applying for your takeout financing once the project is built. So when you're looking at, leverage and ratios, having to only put in, 5% equity, for example, that can, help at least developers and buyers or investors in the long run, right? Because it would allow them to, spread their equity across multiple properties to help grow their portfolio.
Yeah, so let's talk about that. So let's say I've got a small group of investors. Walk us through the process. So how much, obviously they have to pick a site. Probably a major street probably would be a good idea. Is that correct?
Yeah, major street would be a good starting point. I mean, that's where, of course, you could add the most density. And you're not having to go through the hoops of
approvals and like that.
Of approvals, but specifically, like I had mentioned on the 4+1s, having to close out one building permit to apply for another. So it's just, a lot of hoops. Of course, you're getting development development charge waivers, but again, it's just, a lot of steps to get to that financing stage. Whereas, if you're looking at the major streets, yes, if you go for 10 units, now you could be, you have to pay your development charges, but at the very least, you could be adding density to a, single family site, right, where there was a single
family
residential home. Yeah, exactly. So it could be the most benefit and the easiest way to get density onto that site.
Very interesting. So, and you know what? Maybe development charges are going to come down at some point with the new government. That's what I'm hearing with Mark Carney's plan for housing. But we'll see.
I've heard these conversations as well. I mean, I did recently see that
you voted Toronto, you voted conservative, didn't you?
I mean, I'm not going to reveal what I voted, but yes, I do. Tend to believe in the conservative platform a little bit more, at least for the commercial real estate space. So I think it was.
I'm looking at Mike here because he's a diehard liberal. So
that's okay. You know what? We live in a democracy, so everybody's entitled to their opinion. Yeah.
Small L liberal, not capital L.
He's diehard. So, but anyways, that's interesting. So let's walk it through. So let's say I get a house on a major street. How much equity, like obviously I come to you for financing. How much money do I have to have into the deal right off the bat? So is it 25? Do I have 25% in it? Do I have to have something like more like 50% equity in the project? Tell us a little about that.
I imagine that you'd be acquiring this site unentitled, so meaning that you'd have to obviously go through the process of getting your drawings, getting the the site approved for building permit. In that case, if you are looking at commercial financing for that land to get you to the point of being able to get a construction loan, in most cases you would be at 50% of purchase price, meaning that you would have to put in 50% equity. So if you're looking at a site that's $1 million, just as an example, then you would have to put up $500,000. Now that land loan would be interest only, meaning that you're not paying down any principal while you're holding on to that loan.
So I can get that. I can get that from you. Is that what you're saying?
Yes. I mean, we're we help facilitate those loans, but yes, we would help facilitate that. Now, some lenders, may consider going up to 60% of purchase for these land loans, but I would say that it is rare in today's market, just given some of the risk aversion that we're seeing from lenders.
So if I get like 2 or 3 buddies and we all put in some money, or maybe it's 4 or 5 buddies, put $100,000 in each, we buy that house, we have a mortgage on it. Can I come to you, or do I have to go do a traditional mortgage company for that?
No, so you could come to us and we'd help you find that land financing.
That land financing. Okay. Yeah. So now I've got the land. I've got about 50% in the deal, right?
Yep.
And then I'm going to get my design going. I'm going to get all my approvals. So I would imagine that this requires some kind of. Does this require site plan approval for these types of projects?
And if you don't get into the construction side,
I'm talking City of Toronto only.
Yes. So you would require. I mean, again, depending on what you're building, you may require a minor variance to get that project approved and then ready for the building permit. Imagining that you have everything in place, then your construction options really are twofold. You could go the traditional route, which would be conventional financing. So that would be non-CMHC financing during construction. And, most lenders in that space do top up at around 75% of cost, meaning that you would require to put in 25% equity prior to getting your first draw.
But I have my equity in the land, and I've got it approved. So my appraisal is going to be higher, right?
Yeah. So again, it depends on what the total budget looks like, right? Because if you do have 50% equity from your land, there is a chance that that is sufficient to make up the 25% of the total project.
Right.
So just as an example, if it's a $5 million construction budget, including your land of $1 million, 25% would mean 1.25 million, I believe. So that would be 1.25 million of equity required prior to getting your first draw. Now, if we go back to my initial example of that $1 million land, which you got a $500,000 mortgage on, your land now makes up $500,000 of your equity. So,
of course,
if we go back to the the total construction budget at 1.25 million of equity requirement, you would now have to put up an additional $750,000 to get to that requirement.
So I have my buddies. Everybody has to pitch in a little bit more. Is that right? To make that work?
That's exactly right. Yeah.
And so if I but I also have some costs that I've incurred.
Yep.
Which will count for equity as well. Like, for example, all my design costs and stuff like that, my permit fees and all that.
Exactly. So your engineers, your architects, your plans, your fees, all of these obviously make up your costs that can count towards the equity.
Right.
And then, so I had mentioned that the conventional side being 75% of cost. Now some lenders, may allow you to go up higher than that. Call it 85% of costs, which now, in that same example, would only require you, to put up 15% equity. And then there's CMHC. I had mentioned earlier
so you'd want to go for the CMHC loan if you can.
If you can, yeah. Now there's a number of items that you have to consider with CMHC. For example, if you go through the MLI Select program, you would need to attain certain social criterias. To get to that full 100 points, which is the maximum number of points under that program. In all likelihood, you would have to layer in energy efficiency with affordability, which would require 10% affordability, as well as the maximum number of points through energy efficiency.
Mm-hmm.
And then from there, if your debt service ratio supports it, then like I had mentioned, you could go up to 95% of costs. Now, CMHC does have what they call a rental achievement requirement for certain applications. The rental achievement requirement would limit you to 75% of costs during construction, with the ability to go up to 95% of cost once your project is built and you've achieved what they call the effective gross income target, meaning that your property is now stabilized. Sorry. In that situation, it would require a lot more equity up front. So back to that 25%, with that equity being repatriated to the maximum approval once your property is stabilized. That requirement for rental achievement is on a case-by-case basis. So CMHC will review the application once it gets submitted, and they will determine if a rental achievement requirement is required. If the rental achievement is not required, then you could go up right from the beginning up to 95% of costs if that's what was approved.
I see.
At
the beginning,
right at the beginning. So if we use, let's just assume 95% of costs.
Let's use like a great example, like I'm buying a house, major street, and I want to do 10 units. That's kind of pre-approved for 10 units. Yep. And then it's an easy approval process with the City of Toronto.
Yeah. So if we go back to my example of $5 million construction budget, if you only have to put in 5% equity, then in that example, you would really only have to put in $250,000.
Oh, wow.
So pretty sizable difference, right, compared to the 1.25 million that we talked about in the conventional option at 75% of costs.
Yeah, that's great.
So that's where, of course, like you could, minimize your equity requirement and potentially, spread it across, 2 different projects. Now, I wouldn't recommend taking on, too many projects all at the same time, because that's where you could
Trip yourself.
run into a lot of a lot of other issues.
Are there equity requirements for that CMHC looks at, like personal net worth requirements?
So they do, yeah. So I mean, there's 2 different things to keep in mind from the personal net worth as well as the experience standpoint. CMHC has their requirements, and then lenders who are the ones financing those CMHC loans also have different requirements, or they could potentially have different requirements. Now, a lot of it does, overlap. On the net worth side, CMHC requires a minimum net worth of 25% of the net loan amount. However, for construction loans, we do see a lot of lenders with a slightly higher requirement, being 50% minimum net worth relative to loan amount. But lenders also want to see liquidity from the borrowing group, being the borrower and the guarantors, and liquidity would come in the form of cash, marketable securities, lines of credits, essentially anything that could be utilized in the event that there is a cost overrun. And the threshold that we see most often from lenders is 10% liquid assets relative to the hard and soft costs of the project. So just as an example, if your hard and soft costs were $4 million, then lenders would typically want to see liquidity of about $400,000. Yeah.
That's pretty interesting. So let's say, taking that into consideration, and we're going through the MLI Select program, how much money can someone make? And so let's say they could sell the asset. The options at the end of it is they can sell the asset at the end, right?
So
they can take the equity. They can take the equity out. They can hold on to the property. Give us the options at the end.
Yeah, so the 2 main options are you build a project and then you sell it to a third party buyer, or you build it and then you retain it yourself. Yes. I would say that in most cases, people that are building are trying to retain the property at the end of the day.
Right.
However, you always have the option of selling. Now, if you're applying through CMHC for the construction loan, your options are a little bit more limited, because your loan is approved at the time of application, meaning that if rents increase over time, you wouldn't be able to resubmit an application to CMHC, or you wouldn't be able to negotiate a higher loan amount. So whatever loan amount is being approved by CMHC at the time of application is the loan that they're guaranteeing, but also approving, all the way through to completion. Right. So in some cases, if you're looking to sell the asset, and if that was your objective from the start, then maybe a conventional loan would be more appropriate, because it gives you more flexibility at the end of the project, because you're not locked in to a loan. Right. Now, through CMHC, if you choose to sell the asset at completion, or even a couple years after completion, a buyer can go through the process of assuming that mortgage.
Right.
However, there are different requirements when it comes to an assumption, as opposed to just buying the asset mortgage free and then applying for your own mortgage at the time of acquisition.
Okay. So most people are retaining the asset. Is that the majority of them?
Yeah. the majority of people are looking to retain the asset. So they're building it and trying to hold on to it for the long term.
Yeah, and with the idea of getting rental income from it and making some money over the course of holding the asset. So
yeah,
how much let's say, like, take an example of a 10-unit building. What are people, my initial investment, will it be something like $500,000? Will it be more?
I mean, the initial investment to, yes, of course, acquire the land would probably be in the neighborhood of 500,000.
And then let's say I put 100 and 200 grand in soft costs, for example.
Yep.
So I'm into it for like 700,000.
Yep.
Is that enough?
It could be. Like I had mentioned, in most cases, your range could be as much as 25% equity in to as little as 5% if you get approved through CMHC. Now, if you use like a middle ground of 15%, which could be a single conventional lender providing you up to 85%, or you do a mix and match of 75% first mortgage lender with a mezz loan up to again that 85% mark, maybe a little bit higher. Now you're looking at call it 10 to 15% of equity, in which case, coming back to that $5 million example, maybe
close.
750,000 is enough. Yeah, exactly.
You're close. So, what are people so after the deal is done, I finish my project, what are people like netting in terms of income on a property? Like, let's take a 10-unit building off the bat. After all said and done, and they've got their CMHC MLI Select loan, and they finished, what are all the investors making afterwards? Netting on a building.
Well, I guess you'd only be netting something out if you're selling it, right? But if you're looking purely at cash flow,
cash flow.
I mean, it would have to be. I mean, I don't have the numbers in front of me, but you'd be looking at, if your debt service ratio is 1.1, you'd essentially be looking at 10% above break even, right? That would be your cash flow.
10% above break even.
Yeah.
I see. Okay. Is that good?
I mean,
is it worth it in the end, or?
It depends what your objective is, right? I mean, if you're looking to build out a portfolio, then yes, because it allows you, the lower debt service, although it doesn't net you, as much cash flow on a monthly or even annual basis compared to, having a higher debt service ratio. It does allow you to spread out your equity, right? So like I had mentioned, maybe now you own, two different properties. Yeah. And now both of those, yes, maybe are earning a little less cash flow, but it is allowing you to at least expand your portfolio. And, if you, are, lucky enough to be able to grow your rents and optimize your net operating income, then over time, your cash flow grows. And then if you're looking at the long term, call it 5, maybe even 10 years, and you refinance your properties and you have the ability to draw out equity, then you could use that additional equity to continue to buy other assets or build other assets. And over time, you do build out a portfolio, right?
Sizable portfolio.
Commercial real estate is certainly a long-term investment. Over the line, like especially during the the COVID era, there was a lot of speculation in the market. So you saw people buying land, flipping land, buying buildings, flipping buildings, and I would say that's not a normal market. Traditionally, in the commercial real estate space, it does take years to grow your portfolio, build up equity, which is why it's not for everybody. For those that are really just looking for a quick flip, I mean, commercial real estate is not it. And you'd be better off just investing in the stock market.
Yeah. Well, it's some people love the pride of owning property. They see real estate as a safe haven. even though at times it can be very cyclical. Like we're seeing right now, the market's very tough right now, but there's also opportunities as well. And perhaps in the next 6 to 12 months, we might see an improvement in government policies that might even help housing even more, make it more profitable.
Exactly.
So if I got stuck with development charges a year ago and they're coming down, it's even better investment, obviously, too.
Exactly. And I mean, one thing for, commercial real estate, but I guess, all real estate out there is, they're not making any more land, right? So
exactly,
if you're looking at, the next 100 years, I mean, for sure, your property is going to increase in value just because of the imbalance in supply and demand.
Right. Well, this is pretty exciting, and we're learning a lot, obviously. Are there red flags that you're seeing out there, and are there any case studies that you guys offer for people to look at when a group is trying to invest in these types of properties? Are you dealing with always experienced developers, or are you dealing with just average investors?
I mean, we deal with all kinds of clients and borrowers. So that would be, experienced developers as well as,
newbies.
What I would call
newbies.
First-time developers. Now, my, I guess, suggestion to those that are new to this space and looking to get into development, it would be to partner with somebody that has experience. Whether that's from the borrowing group perspective, so bringing in an equity partner and a guarantor that's done this before, or hiring, of course, the right general contractor or construction manager. Making sure that
Fusion Corp, right?
Exactly. Making sure that the team around you, has the experience. And if you are a first-time developer, starting on the smaller scale, right?
Yeah.
Instead of jumping into a 10-story, 60-unit building, maybe you start with a sixplex. Of course, there's risks right across the the development spectrum, but your cost overruns aren't as large if you're looking at a smaller project. There's less things that could go wrong. For example, on a 60-unit building, you likely have one, maybe 2 stories of underground. The further you dig, the more likely you're going to find something that could go wrong. Whereas a sixplex, you may not even need a full basement, right? So you're not having to put in, or there just isn't as much risk from a development perspective.
Right, for sure. Well, I always say go big or go home. So even though this is missing middle housing. So what's happening for the future of housing finance? Is there anything new or anything innovative coming down the pipeline?
I guess that'll be, a question to ask me in a few months. We just went through a federal election, and
good answer.
The liberals, the liberals have talked about a few different things. For example, creating a new agency for them to invest in modular development or prefabrication development. They've also talked about them becoming a developer.
What a disaster.
So again, at least there's talk of increasing supply. What that looks like down the road is a different question. I agree with you. I'm not exactly sure the government should be a developer in the marketplace, and instead they should be helping cut barriers and red tape and making it easier for developers and buyers to access low cost financing. I think that would be the best option, because you leave it to the experts to handle the development and actually get it done, and it gives them a nudge from the policy standpoint.
Right. So yeah, I agree with you. I think we're going to see something new and innovative coming in the near future. I think there's a lot of opportunities for people. You may like them or don't like them, like the liberals, don't like the liberals. Probably most people don't like the liberals, except Mike. But we may, I think we have to be open-minded, give people a chance, and see what this new government's going to do. And I think they're interested in helping housing. Now, how we get there is another story, what they actually do. I don't like government being in the business of building, because then, that's what we're all here for. Like I have a construction company, give us that money. Just kidding. But I'm just saying, give it to the people that are experienced, because we all know that government projects get out of control and
I was going to say, I mean, if you look at any, infrastructure project, at least in this province, I don't think a single one has been on time or on budget. And not to say that, that happens even in the private sector, but it's just, the delays that we see, in some of these government initiatives are just, crazy.
Yeah, I think they have to like, if we're going to do this and we're going to improve housing in Canada, then we got to give it to everybody.
Yeah.
All types in the housing sector, so that large obviously large construction companies are going to be doing government run projects, because that they're they're bondable. They'll probably guarantee a price or something like that for the government. But those are big projects, big undertakings, and a lot of people don't have access to that type of space, especially smaller boutique construction companies like myself. So we won't be able to do
exactly.
anything there. But they should
and
be
really, to solve the housing crisis. I mean, we need
everybody's
participation.
participation.
Exactly. Yeah, we need everybody from big and small, right, to make it happen.
Yeah, no, it's really good. So how about this? I think we're gonna wrap up pretty soon. But any advice for first-time infill developers? Be careful.
Be careful. I mean, a lot of people, especially when they hear about the MLI Select program for the first time, all they get fixated on is, I only need to put in 5% equity.
Yeah.
I could do this. But at the end of the day, any kind of development is risky, right? I mean, it takes, sometimes years to get to the point where you're finally finishing a project, or even starting it, depending on the size of the project in a city like Toronto.
Yeah.
And a lot can change. You could have higher costs. You could have different market dynamics. Rents can change, demand can change. So again, it's risky business. So do your research. Partner with the right people if you need to. And above all, at least these days, is ensure you have the right amount of equity to get it done and to cover any cost overruns if there are any that occur.
Yeah, that sounds like a good plan. So I might be holding a future event on Building Success series, and we're going to be talking about the missing middle housing. Perhaps you and GreenBirch would like to come to one of those events at one of these days.
Yeah, that would be great. Yeah, just keep me posted.
Yeah, any final words, Jimmy? Jimmy, you did a great job. Excellent information you provided to everybody. Like I said, I think the takeaway here today is, yes, real estate can be amazing, but it's a long-term thing. You need make sure you put enough equity into the project. Pick projects that are work with an experienced group if you can. And there's a lot of risk. And don't overlook the risk, because anything can happen these days. Jimmy, you still there?
Yep, still here. So one final note from me is, right now we have, at least in the city of Toronto, a lot of inventory coming to market, especially on the condo side, and I think it's scaring people from bringing more supply to market, but
it's a different type.
Nobody's building right now, or there is a shortage of developments starting today, and if you could look past the current storm out 2 to 3 years, there will be little supply coming to market at that time. So if you have the experience and you have the equity to build through the storm, I mean, you may be one of the only developments coming to market when you're finally done. So it's
Great advice,
it's
great
worthwhile getting into it even now.
Well, I'm going to just say one more word because I didn't really I'm promoting you a lot and your knowledge, but GreenBirch, everything I've seen from them to date, and because of your representation, Jimmy, you guys look like an amazing company to work with.
Yeah, thank you. I appreciate that.
Yeah, and well done. You're a wealth of knowledge, and I'm sure we're going to hook up again very soon. So thank you very much, Jimmy.
Yeah, thanks for having me.
And thank you for listening to Building Success Series with Nick Ainis, a podcast breaking down real estate, investing, business growth, and making money. Proudly brought to you by Nick Ainis Enterprises. Please share, like, and subscribe. We'll see you again in 2 weeks.